morning, everyone. Thank you so much for being here. So here we are. Welcome to HSBC's Premier Investment Global Market Outlook. It is my great pleasure to welcome all of you here today. And I also want to say a special welcome to a very close friend of mine, Gretchen. She is visiting from the States. And to reward her for her 30-hour trip, she's joining us tonight. So thank you, Gretchen. But it's wonderful to have someone from home. It was undoubtedly a challenging 2022 for financial markets, with the Eurozone and the UK being in recession, the US economy growing well below trend, and with China's economy impacted by its zero COVID restrictions. 2 months into 2023, we see some of these headwinds dissipating. For instance, we see inflation moderating, consumer and business confidence picking up, and the reopening of China's economy posing the biggest upside risk for the global economy. And though it is still too early to tell, central banks could be coming to an end of their tightening cycles. We are cognizant that some of the risks seen last year are still prevalent in today's markets. However, we think that there are opportunities to be unlocked. We just have to find a silver lining amidst these challenges. In our view, the silver lining that we see is the investment climate this year is due to the trifecta of peaking U.S. interest rates, a softer U.S. dollar, and a reopening of China's economy. These factors could help investors make more constructive investment decisions this year. Ladies and gentlemen, we believe that diversifying and rebalancing your asset allocation in today's market is absolutely crucial to build a resilient portfolio. At HSBC, we're here to help you build a wealth strategy that works just for you with our suite of investment services. We take the time to understand your investment needs carefully and provide you with tailored solutions to help you grow, manage, and preserve your wealth. Our ambition is to be Asia's leading wealth manager, opening up a world of opportunity for our clients wherever their wealth is created, invested, and managed. Malaysia, as a core Southeast Asian economy, is an important part of that narrative for HSBC, and we are committed to serve your financial needs as they evolve. Our panelists here today will provide you with insights on how you could make the most of your investment amidst diverging economic trends. We hope you find the discussions informative and useful as you evaluate investment opportunities and structure your portfolios to optimize returns. I would like to thank you all for coming tonight. I would like to thank you all sincerely for your business. And I wish you an insightful evening ahead. Have a good evening.
I'd like to invite James Cheo, the Chief Investment Officer for Southeast Asia at HSBC Global Private Bank and Wealth. Please, ladies and gentlemen, a round of applause for James.
Well, thank you everyone for having me, and thank you, Renee, for setting the stage and hosting this wonderful event. The theme for today is looking for the silver lining, and I will show you where the silver linings are when it comes to financial markets. But clearly in financial markets, it's really about being adaptable. You know, I started my career 20 years ago. And 20 years ago, what I have is 4 screens on my office. And what I do is I monitor economic data and try to interpret what happened in the US the night before and try to find out what's the impact for Asian markets. So that 4 screens served me very well. Only when 2016 came, that 4 screens didn't work very well. You know why? Election of President Trump, right? You have tweets. So I have to monitor his tweets because the 4 screen didn't capture those tweets. But then after, when 2020 and 21 onwards, President Biden, not much on the tweets front, so I don't really need to monitor President Biden on the tweets. But then one new person that I have to watch out for. Any guess on tweets? Tweeters? Yes, Elon Musk, correct. And you know, for Elon Musk, right, you know, as analysts, we always want to be one step ahead. We want to be a little bit smarter. So I have a friend who covers Tesla, the company. So I asked him, if I want to know more about Elon Musk, I don't just follow his tweets, right? Who should I follow to understand him a bit better? And you know what that Tesla analyst told me? He said, in order to kind of know Elon Musk, you have to follow his girlfriend. Wow, that's a good one. And then I asked him, which girlfriend? So no, but that's a joke. But the thing is that financial markets is going to be very, very volatile, and 2022 has been an extremely challenging year. What it had was that equities and bonds both registered negative returns, which actually, from a historical point of view, it's a very rare occurrence. It only happened 9 times out of the past 75 years. And one good news, the first silver lining that I can give is that history is on our side, because never before are there 2 consecutive years in which you get negative returns for both equities and bonds. So at least 2023, at least from a historical point of view, you should get either equities or bonds registering positive returns. And of course, historically, if you do get a negative returns for 1 year, the next year, historically, equity prices usually rally by 20%, bonds by 8%. But if you look through the episodes of when we had those situations in which both bonds and equities both registered negative returns, was really because in the 70s or even the 80s, when there was an inflation problem. Similarly, like last year, the playbook was the same. Because there was an inflation problem, central banks had to increase rates very fast, and as a result, that brought the economy to a slowdown, and in some cases, a recession, and that's why you got negative returns for both equities and bonds. The good news is that this year, 2023, the peak of inflation to us is already behind. That means the highest point of inflation was probably 3 months ago. And we are witnessing a point in which inflation is already starting to ease. Goods inflation has started to improve across the board, in which shipping costs and things associated with supply bottlenecks, those have improved significantly over the last year. But of course, core inflation, things associated with labor markets, wages, rentals, those things are still a little bit more sticky. So I think that the trend towards the rest of the year is that inflation should start to fall gradually. It will not fall back to that 2% target that the US Federal Reserve wants to target, but I think there is a good chance that inflation could stabilize to the 3 to 4% range, especially in the US. And how about the growth outlook? Last year, there was a lot of fears about recession, and clearly last year, the US economy was actually fairly strong. The US economy did not enter into recession, and we think that this year, make no mistake, growth is slowing down, especially in the developed markets. The industrial cycle is actually slowing down quite rapidly, but I think there is some resilience in other parts of the world, especially Asia. To us, the reopening of China is perhaps the biggest economic event for 2023. And other than the peaking of inflation, which is the first or the silver lining that I want to talk about, the reopening of China is also another silver lining that is very important for growth in the region. Because as China reopens, it will also lift the growth of Asia and many parts of Southeast Asia. So what should be the priorities now, given this backdrop? How should I invest? Because the environment is still a bit volatile. And clearly, I think there is a few important relationships that one should think of. We have already seen the peaking of inflation, which also means that we are very near the peaking of interest rates. I think the Federal Reserve can still increase interest rates by another 1 time in the next meeting. Perhaps the markets think that it could be another 1 or 2 times, but we are clearly at the end of the hiking cycle, which means the peak of interest rates is very near. It's going to be in the next 1 to 2 months. So that's a very important signal. And of course, with that, it also means that there's going to be very much a slower growth outlook in many parts of the developed world. So I think, how should you kind of position your portfolios? Clearly, at this stage, with the sort of uncertainty, you want to be neutral on global equities, and you want to be very much overweight on bonds. That's the current positioning. And in terms of currencies, we are bearish on the US dollar. We think that the short-term strength in the dollar is probably temporary. We should see dollar stabilizing and falling because of the peaking of interest rates. And so with that, there are a few milestones that we have to watch out for. I think the first milestone is clearly when rates will peak. We think that it could happen as soon as in the next month or even in March or April. So this is a key kind of timeline that one should watch out for when it comes to interest rates. And when the peaking of interest rates happen, you want to extend your bond duration. You want to go further out in terms of capturing more returns by going longer duration in terms of your bonds. And also with the peaking of rates, you might also want to take up a little bit more risk in your equity portfolio when it comes to growth stocks. And the next milestone that you want to watch out for is when growth stabilizes. Things are slowing down, but we should see the bottoming out of growth perhaps in the second half of this year. It could be as early as Q3. And when you see a bottoming out of growth, perhaps that's the time that you want to be a bit more aggressive when it comes to your equity allocation. But meanwhile, we are seeing that for the first half of this year, it is going to be an Asia and China story. It's very likely that Asia would likely outperform the developed markets in the first half. And in the second half, perhaps we might see the reversal. So I think these are a few milestones and a few broad strokes that one should watch out for when it comes to asset allocation strategy. But first and foremost, I think there are a few priorities that you can do right now. I think what's also important right now is to put your excess cash to work, particularly in the bond markets. We think that global investment grade bonds are very attractive right now. You can easily capture 5-6% in dollar terms, which is actually very good when it comes to bond investing, because never before in history or the last decade or so that we have such a strong return when it comes to bond markets. The next priority you can do is, of course, to make your equity portfolio a bit more resilient against recession risk. This means that you want to avoid places that are facing slower growth, particularly in Western Europe or even in the UK. And you want to be overweight, particularly in Asia, where the growth dynamics right now is actually stronger. We are overweight in China, we like Hong Kong, but also parts of Southeast Asia like Indonesia and Thailand, which we think that they can benefit from China's reopening. The next priority that you could do, the third thing you can do, of course, at the heart of it is really about diversification. And you don't want to kind of put all your eggs in one basket, whether it's equities or bonds. You want to think of increasing the resilience of our portfolio by thinking about alternative assets, such as real estate, such as commodities. And also, I think with that sort of asset allocation in mind, your portfolio can be much more resilient to any of such risk. But also, don't ignore currencies. We think that for the last 2 years, we have been dollar bulls. We think that now that has changed. We become dollar bears. Yes, there's short term, we are facing a little bit of dollar strength, but with the peaking of interest rates going to happen in the next 1 to 2 months, we think that the dollar should start to weaken. And I think that's something to think about when you have your currency exposures when it comes to your investing. But I think the biggest story this year, of course, is China's reopening. And recently, I was in Indonesia, and I met a gentleman, Indonesian gentleman, and he told me the theory behind why China had a zero COVID policy, and then they suddenly reversed. And this was the best theory that I've heard. So when I was talking to him, he told me that the reason why China had zero COVID policy for 3 years was really because China wanted economic growth, and they think that with lockdowns, you can actually have more babies. And with more babies, your economy can grow faster. So that was the theory. More babies. I thought, wow, that's quite an interesting theory. Then I asked him, with more babies, if we lock down, you get more babies. Then why did they suddenly U-turn the policy right away in the end of last year? And you know what his theory is? He said that with the lockdowns, instead of getting more babies, you actually get more divorce. And that's why they have to quickly reopen. Well, I thought that was quite an interesting theory, but nevertheless, I think China's reopening is not going to turn back anymore, because clearly they have reached herd immunity much faster than what most people expect. And I think when you look at the tourism flows, especially during the Chinese New Year, it's almost back to pre-pandemic. So it's going to be a story that's going to boost growth, particularly in Q1, Q2, and I think it's going to be something that investors should watch out for. And another very important feature is also in the property market. China went through a self-deleveraging when it comes to its property market over the last 2 to 3 years. But I think that has also changed. They have put in so-called the 3 arrows in which they are providing funding support when it comes to credit, equities, and bonds for the developers. So it's a way of backstopping the property market. It will not lead to a V-shaped recovery back to pre-pandemic days, but it will certainly provide a floor. And I think that's going to be quite an important policy shift when it comes to China's property market. Recently, I met a client from China, and they told me that despite all these measures, the property price in China, particularly in Beijing or Shanghai, is still very expensive. And they told me that in order to own a property, you have to be a cat. Cat. Then I said, what? What do you mean by cat? He said, yes, you need to be a cat because in order to own a property, you need to be like a cat with 9 lives to pay off. So that's something quite interesting. I'm not sure about in Malaysia whether you need to be a cat, but probably most of us have to work as hard as a dog to pay off our mortgages. But I think nevertheless, what's very important in China is, of course, we think that the opportunity right now for China is extremely exciting because the stars are very much aligned in that valuations of Chinese equities are almost at pandemic levels. But back in pandemic levels, at that time, back in 2020, you don't have the vaccine, there's lots of uncertainty. This time round, there's a little bit more clarity. And when it comes to policy, there's a clear policy towards growth, the departure of COVID policy, the support from the property market. All these alignment makes us very compelled that Chinese equities is the place to be at when it comes to an asset allocation for Asia. And we think that China equities offer very attractive risk-reward, especially right now. Of course, where are the opportunities across Asia? The most obvious one, of course, is China's reopening. As China reopens, the most direct benefit, of course, is Chinese tourists. Pre-pandemic, there was about 150 million outbound Chinese tourists, and I believe that this Chinese tourists are starting to book their flights and travel, and they will start to travel around the world. So this is going to be a very powerful force. And if you assume each of the Chinese tourists to spend $2,000, which is not a lot when it comes to revenge travel, you multiply that by 150 million people. That's a $300 billion business a year. It's not just for 2023, it is a business for 2024, 2025. So that's going to be how powerful when it comes to the outbound travel by Chinese tourists. And of course, the most obvious beneficiaries will be the airlines, F&B sectors, consumer discretionary, companies that sell into and for these Chinese tourists, even the European luxury brands. These are the sectors that we think can benefit significantly due to China's reopening. And of course, Southeast Asia is also going to be one of the beneficiaries. With China's reopening, there will be, Thailand is going to be one of the most obvious destinations that the Chinese tourists would like to go to. So Thailand is an economy that we think can do well. And also Indonesia would be interesting in the sense that commodities that the Chinese consumers will want to buy, those can do very well. So in terms of our Southeast Asia allocation, we are bullish on Indonesia and Thailand. But over the longer term theme, we think that Southeast Asia is extremely exciting on various dimensions. I have been a watcher of Southeast Asia for many years. Sometimes when you watch Southeast Asia, it feels like you're watching a slow motion movie, but somehow it moves in the right direction. 20 years ago, the size of Southeast Asia's economy versus Japan is very, very stark. Japan was 9 times larger than Southeast Asia. Fast forward to today, the size of Japan's economy is 1.5 times that of Southeast Asia. So we have made progress, but sometimes it's fairly slow. But we think that this time round is different, that there are many factors around that wasn't present over the last few decades. And clearly, I think technology, the digital economy is going to be one key dimension. Of course, the other parts would be the green economy that is going to be a very powerful force when it comes to energy transition for the region. And what's also important to tie the whole region together is really the regional free trade agreement, the RCEP, Regional Comprehensive Economic Partnership, that brings together Southeast Asia together. And I think that's something that would spur investments and trade for the region in the years ahead. And clearly, the region as a whole provides a good source for supply, global supply chains looking to diversify. So Southeast Asia is going to be a very important theme for investors to think about and allocate in their Asian portfolios in the years ahead. And of course, when it comes to bonds, if you want to have a little bit more juice when it comes to the coupons, you can look at Asian credit, particularly quality credit in the Asian space. You can easily get 50 basis points to 100 basis points more in terms of coupons. This is a place that you can look at other than global investment grade bonds. And also, I think one should not ignore Asia's green revolution or green transformation. This is a very powerful theme. I remember that about 3 years ago, do you know during Chinese New Year, you usually give out red packets to children, right? So 3 years ago, I have a nephew. At that time, he's around 9 years old. So I gave him a red packet with cash. So when he took the cash, he says he doesn't want the cash. He wants it in Robux. Robux is the currency used in the game, the Roblox metaverse. So it's a gaming currency. So I asked him, why don't you want cash? Why you want it in Robux? And the boy was very smart. He says that, I don't know for you here in Malaysia, when you give the cash to the kids, right? At the end of the day, the parents will take back the cash and put in their bank account. Right? In essence, the parents actually take back because you understand the game. It's almost a net thing, right? Because the kids receive, the parents give out. So at the end, you net it. So that boy understands this whole thing. So he says he don't want it in cash. He wants it in Robux so he can keep that currency. Very smart boy, 9 years old at the time. Then the subsequent year, when I meet him again during the Chinese New Year, I asked him, do you want your Robux this time round? He said no, he doesn't want Robux. You guess what he wants? He wants Bitcoin. Oh, smart boy, huh? Then fast forward to just this Chinese New Year, I met him again. I said, oh, but by the way, I couldn't give him 1 Bitcoin. It's too much for a child. And, so I had to give him a fraction. And this Chinese New Year, met him again. Now he's 11 years old. So I asked him, do you still want Bitcoin? He said, no, I don't want Bitcoin. Not because it crashed, but because he told me he don't want Bitcoin because Bitcoin needs a lot of miners, data miners. It needs server, and it's actually, he says, it contributes to global warming. So I thought, wow, 11-year-old boy is pretty smart. Can tell, he understands the concept of global warming, and even owning Bitcoin contributes, increase the carbon footprint, contributes to global warming. And I asked him, so where do you learn all this? Did you read a book? Did you watch a documentary? And you know what he said? He said he actually learned it through a movie about this. And you know what movie is that? Ice Age 2, The Great Meltdown. And that's where he learned about global warming. And sometimes it's quite interesting what small kids can teach us so much about climate change, about green transformation. And clearly, I think the biggest challenge that the world is facing is climate change. But the world is not spending enough to solve it. The world needs to spend around $9 to $8 trillion every single year to reach net zero. We are not spending that yet, but I believe that as the world starts to recognize the importance, transit the energy system, whether it's towards renewable energy, invest in new green technology to enable much more efficiency. And also, I think it's going to manifest in many parts of our lives, whether it's the electrification of our transportation system, making our cities much smarter in terms of building management when it comes to energy efficiency, or even through the transition of how we use our daily lives through the use of even the circular economy. So I think this transformation is going to be a very powerful theme in the years ahead. So I think in a nutshell, I think there are a few priorities that you can do. Clearly, first, deploy your excess cash into the bond markets, because at the short term at least, we think that's where the opportunities are. And secondly, the next thing you can do is to make your equity portfolio a bit more resilient. You want to look at Asia, particularly in China, Hong Kong, parts of Southeast Asia, where we think the resilience is in. And of course, ultimately, at the heart of investing is really about asset allocation. And I think that's going to be a very important part for everyone when it comes to investing. And once you have a very diversified portfolio, a diversified core portfolio, you want to think about longer-term themes. Longer-term themes such as Asia's reopening winners, longer-term themes such as Southeast Asia, or even longer-term themes such as Asia's green transformation. So I think with that, I've come to the end of my presentation. I thank you, everyone, for listening to it. Thank you very much.
And now I'd like to invite Marcus Chia, Treasury Specialist at HSBC Malaysia, up on stage for his presentation.
Hi. So what I'm going to do is I'm going to spend roughly 15 minutes to 20 minutes. I'm going to cap it. I'm going to explain to you how we at HSBC look at numbers, how we interpret it. So hopefully it can help you along when you're going to do your own investments in currencies. So starting off, this is one of the first charts we look at most mornings. This is a synthesis of several tools, hedging tools within the market. And it sets the tone for us to understand how investors are going to react. Are they feeling frisky? Are they feeling afraid? So from here on, this was on this was Friday's data. So the US market was more towards the greedy side. So that will set the tone for us because the ringgit is a commodity currency, it's considered a commodity currency, and it is one of the currencies that will benefit when people are feeling a bit more daring and adventurous. Okay? So, recap, what has been influencing currencies? James has mentioned that people are going into the market, things are looking better, inflation is peaking, is coming down, but you don't really see that in the ringgit. If you actually look at ringgit today, it's 448. What exactly is happening? And it would be good to have a recap right now, because that will give a better explanation from start to finish. It will actually string a narrative for you. So back in 10th of January 2020, the WHO announced that there was a breakout of COVID. And you can see that inflation dipped immediately after that because everyone was scared. They stopped spending. But after a year or two, inflation slowly crept back up again because of logistical issues, bottlenecks, And coming back to here, 2023, governments across the world have been trying their best to cut this inflation because it has been very, very painful for the general population, the person on the street. So inflation is coming down. I've given you 2 lines. One is US, which is in blue, and in black is Malaysia. So the inflation profile for most countries in the world are very similar to this. Inflation is coming down. The question is, can it come down faster? And that's what's been governing our currency flows most recently, while we are at 448. So when you have high inflation, governments raise interest rates. It's one of the most easiest ways to slow down growth is to make cost of funds more prohibitive, raise it up. So that's what they've been doing. The US interest rate is about 4.75 right now. Malaysia is 2.75. And it has been proven to work. You can see that inflation is down already, And the question is, should they continue on? Should they go at a faster rate? Because if you do not cap inflation, it runs away from you. It's really hard to go back to the days when you had a 50-cent Milo, for example. It just runs away from you. So you want to cap it. And when you have the opportunity to cap it, when your country is strong enough to do it, and if you don't do it, your country gets stronger. For example, in the US, wages and job numbers and the labor market so tight. That again feeds into inflation. So if you don't cap it, then you get the worst of both worlds, where you have high inflation and slowing growth. So you do want to do it. And that's why people in the past week or so have been aggressively repricing interest rates, particularly over in the US, then subsequently in Europe and the UK. Okay. So this is a good example of some of the data that has been moving markets. It is the US jobless claims. So essentially it's the dollar. Over in the US, they are allowed to claim money if you're jobless. And the jobless numbers have been good, very similar to unemployment rate over in the US has been very good. Non-farm payrolls, very, very impressive, 570,000. So all this points towards more pressure because the market is very tight. And then it goes back again to, should they actually raise interest rates faster and for longer, and just finish off, shorten the cycle of raising rates. And then we can start coming back down to normal levels. So very similar story for other countries as well. Should we raise rates faster and for longer? And this is what the Federal Reserve has said. They have expressed concern over high inflation. The indicator that they use is called the PCE, Personal Consumption Expenditure Index, that actually draws prices from businesses. And that has been rising continually. So, from what we can glean from their minutes, they ought to continue raising rates at least for the short term. We expect at least one more March 22nd. And thereon, it will probably be very data dependent. And you notice I've been talking a lot about the US. Why are we talking about the US and Federal Reserve so much when over here in Malaysia, most Malaysians haven't even seen a single US dollar before, right? And that's simply because we cannot talk about our own currencies without referring over to the US. On a daily basis, the Bank of International Settlement tells us roughly 70% of trades deal with US dollars. So we cannot avoid that. Their treasuries are the most fungible, most liquid asset class that you could hold if you were a central bank or investment bank or a pension fund. So it's essentially the risk-free rate of return time deposit that you can buy if you are a smart investor. So people buy into the US dollars, treasuries, bonds, bills, whatever, and it's a huge market. If you look at it from the US, it's the world's largest bourse. New York Stock Exchange, the NASDAQ, makes it the biggest bourse in the world, and also is also the biggest GDP, biggest economy in the world. So you can't avoid talking about the US when we want to talk about other currencies, including the ringgit itself. So where do we stand? We reckon that we are in the period of consolidation, where market is still roughly repricing interest rate hikes, and then it reflects within our own currencies as well. This one is about the runway is nearly done. It's nearly done and dusted. Inflation is coming down. It's a question of how fast can we bring it down faster. How fast can we bring it down? Okay. And we are nearing into the second phase where we reckon US dollars will broadly be going down again, which is parroting what James has mentioned. So when will that happen? We are estimating it to be around Q2 or end of Q2. So if you want to position yourselves, it's very rarely that you have such transparent opportunities to prepare yourselves for currencies. So if you look at it 10 years ago, central banks were never ever so transparent. Right now, they're giving you such good forward guidance that you can plan quite well on what you want to do. And what you have to do is just to glean through their statements and policy statements. So first off, I'll talk about the US, because the US ringgit is the one that we actually benchmark or refer to whenever we talk about ringgit. I'll focus on the US ringgit, a bit of pounds, a bit of Australian dollars, some Sing dollars, and then I'm out of time. So over in the US, you can see that even though inflation is coming down, the number 6.4 was actually higher than expected or predicted by analysts. So there is still some things that the Federal Reserve can do to push it down faster. And this was one that actually started the ball rolling and people were actually pricing in, higher rate hikes. At present, the market is pricing a topside interest rates, or Fed fund rates of 550. So that would mean about roughly 3 more or so. But we reckon it will be about 1 more in March, at least for now. And coming to Malaysia, so we've hit 448 today. We see that resistance at present stands about 450. So this would be a decent level for us. We expect to get out. We overall expect dollar to trend down Q2, and 550 would be a very, very decent level to get out of it. So if we look at Malaysia, I think very often we have a very bearish view on the ringgit and Malaysia. Having spoken to lots of clients, overall view is that it doesn't do as well as we would like it to be. But if you look at it objectively, our country actually is doing okay. So this is Q4 GDP year on year, and we did 7%. The prior period in Q3, we had 14.2% growth, which was the fastest in Southeast Asia. But why is this dichotomy? Why does this feel like our population, the headline news tells us that people are going through so much pain? And that's very true, because of the way our economy is set up, where we have high growth and supported by a lower ringgit, so it doesn't necessarily flow down. And that's why within the latest budget, you see it's very accommodative. And the taxation as well focuses more on the higher earners. Okay. Simplistically, we can break down ringgit's movements or factors, influences, to 4 main ones. On the left, you see is dollar. DXY means dollar index. It could also imply that interest rates are in the US. Next, Japanese yen in gray. You can take it simplistically as risk appetite or safe haven flows. Next is renminbi. Renminbi, because China has such a huge influence over the rest of Southeast Asia. So for the past 2 crises, China actually dragged us out from that crisis. And right now, its influence on ringgit isn't as great, but it used to be the most highly correlated asset class to the ringgit. Prior to that, it was petroleum, then it was renminbi. That's because China has a peg on its currency versus a basket of other currencies, its trading partners, and ringgit has a proportion of roughly 4% in there. So you see China having impact as well. And lastly is EM equities, which means preference for collective Asian assets or equities essentially. And for Malaysia, what is clear is that it's not particularly influenced or under influenced any strong ways. We're actually pretty okay in the middle of the ground. So what is good to remember is that if you're going to look at ringgit and Malaysia itself, you have to look at it objectively, comparing us with our peers. Because very often we just look at ringgit and then look at US dollars and look at pounds. So that's not a fair view. I think a fairer view would be comparing us to, say, the peso or the rupiah or the Thai baht. So we are not all too bad. And from this, you can glean that it is essentially the overall preference for emerging markets that has been driving ringgit flows. And obviously, right now, there hasn't been all that great a preference for emerging markets. And if you look at futures positioning, you can see that it's ringgit's positioning in the futures market. So if it's positive or positive 3 at the extreme, it means there's a huge short on the ringgit. And if it's negative, it's a long on the ringgit. So you can see that ringgit is just in the middle, roughly near the median for this period in the past month. So it's not ringgit itself that has been very, very bad. It's just the entire region that people didn't feel as much love. So I think you go back 1 year ago, a lot of people were telling us that we will have lower inflation, stronger growth, reopening of China, and things would be much, much better. Yes, that's still true, just that it's a bit slower right now. And if you look at ringgit as a whole, we are functioning same as our neighbors. So not all too bad. And where does ringgit stand? We reckon it's slightly undervalued at present by the tune of about 4%. So this chart gives us some of the guidance that we propose in our forecast. So we reckon renminbi is slightly to the rich side, ringgit slightly undervalued, Sing dollar very overvalued, and that is also part of the function that is very, very correlated with the US dollars. So if you have been receiving our forecast, our estimate for where Sing dollar ought to be by the end of the year is about 329 or something like that. It's roughly where we are. It's about 333 today, so it's a slight dip towards the year end. And that's because we expect USD to be coming down second half of the year. Okay. Sorry, coming back to this again. Moving forward. Okay. We also reckon that Aussie roughly is at fair value now, same with Euro, but the pounds is undervalued. So that's why if you've been looking at our forecast for pounds, we've been saying 546 for several months, and we're actually quite near to that now as of today. It's about 540. Okay. So where would you want to place your money, or where you think you can get value? This is the chart, one of the charts that we look at. Okay, so for Malaysia specifically, what can actually improve the ringgit to bring us up faster than our peers? One thing that is very glaring for Malaysia is that Malaysians do not love the ringgit. And ever since we removed our Bank Negara export conversion rule, we saw an upsurge, an uptick in foreign currency deposits. So we would need that to reverse. So that's why when at the very beginning I said a lot of Malaysians that have a very bearish view on ringgit is because that we do see it, that people rather hold the foreign currency than onto ringgit. So this will need to reverse. And it doesn't help that the forward pricing, there's a discount. So you were to buy a foreign currency using a forward with a counterparty, another bank, right? You would get a cheaper rate right now because interest rates in the US is much higher than it is in Malaysia. So how can we fix that? Either the US starts cutting rates or Malaysia starts raising interest rates. So these are some of the things that needs to be remedied if ringgit were to significantly come back up again. And we are hopeful that tourism will slowly trickle back into Malaysia. At present, what we can see is that more Malaysians travel overseas than we have tourists coming back in. So, according to the government, tourism contributes roughly 8% of GDP. And we are hopeful, very, very hopeful that we can get back all those numbers again eventually further down this year. Okay, as a recap, why are we different from US, Europe, UK? This table here is like a behind the napkin kind of calculation, which gives you an idea of the standard of living of Malaysians relative to these countries. Okay, so Rafizi Ramli recently came out and said that we can become a high income status nation by 2026. So high income means 15,200 per person in US dollars, which roughly comes out to be about 5,700 ringgit salary per year. So is that possible? The bar is pretty low, so it is possible. But I'm showing you this simply because oftentimes people ask, why is pounds going to do much better than ringgit, even though US dollars is broadly coming down? Why is UK going to do, why is Europe going to do much better? It's because they have different kind of issues that is a priority for them. While we have this very low base and very large SME, which needs more support. So that's why we have issues raising interest rates, while other countries have no issues whatsoever. And to get the best idea of where ringgit will be going is to take a look at Bank Negara's monetary policy statement. So I'm going to read it to you. Growth in 2023 is expected to moderate and will remain supported by domestic demand. So growth this year will not be as good as last year's, but they expect the people in Malaysia to come in and start propping up the country. Household spending will be underpinned by sustained improvements. So they do expect fiscal policies, like in the new budget, to be supportive of the people in Malaysia and then support the consumption side. So the balance of risk to inflation outlook is tilted to the upside and remains highly subject to any changes to domestic policy on subsidies and price control. So what does that tell us then? They did not specifically mention interest rates. They said it will be tied to fiscal policies on subsidies. So again, reliance goes back again to what the government will do, and they will react accordingly. The MPC will continue to calibrate the monetary policy setting that balance the risks to domestic inflation and sustainable growth. So from all of this, you can see their focus is just to maintain stability in currency and financial markets, and they will change their interest rates or whatever other policy they may have accordingly to data and fiscal policy. So on that basis, everything seems hopeful for Malaysia. Okay, so I'll move on to euro and also to pounds right now. I think I'm running out of time. So for Europe and UK, story is much easier, same with Australia. It's about interest rates at present, whether they will continue raising interest rates faster, longer, etc. It's because inflation is still very high. So EU's consumer price index in the month of January was 8.6%, sorry. And that's a really big number. So imagine if prices rose up 8.6% year on year. It's really, really painful. Over in the UK in December, the inflation rate was 10.1%. So very likely that they will continue raising interest rates, which will actually be supportive as well of the euro and for pounds. Okay. So initially when there was Russia-Ukraine war, a lot of people were worried, particularly Europeans, that prices of energy will rise up, but actually it has not happened. So what we see right now in the Eurozone is that things are a lot better than people predicted. People were a lot more negative. But with that, data has been propping up Europe, and their data actually has been improving. One of the better than expected data within G7. As for the UK, I think more often than not, you still receive lots of very bad headline news. Bank of England themselves have said that there will be 5 quarters of negative GDP growth. That's why there's a recession. But we reckon that they're really skirting rock bottom, and things can only improve. And that's been proven to be true in the exchange rate. Now it's about 540. We reckon it'll be 546 by year end. And whether Brexit has had an impact, the answer is yes, but things are improving by leaps and bounds. They are getting back that trade balance. And as of today itself, there was an agreement signed between EU and the UK regarding Northern Ireland. So that's good news for the UK. So we reckon it ought to continue going back up again. Moving on. On to Australia. So Australia's story also very similar. Interest rates, they are slightly a bit more reliant upon China, and China's story is overall good. Things are slowly improving. You can see that 36% of exports is generally to China. So from what we can glean, Aussie dollar is the most sensitive to risk appetite. So if you haven't have an idea of where Aussie is going, you just look at the risk appetite. And I know this table is painful to look at, but sometimes it's necessary to give it so that it's accountability. So I'm not plucking numbers from thin air. So what you can see from here is that the green boxes are telling you that it's very sensitive, highly correlated to equities, while very negatively correlated to VIX, which is a measure of risk. So just look at how things improve overall in equity markets, then you can actually have an idea of Aussie. As of now, it's roughly 302. We reckon it'll be 319 by year end. Okay? And as for Singapore, simply because they have sticky inflation at 6.6%, rather uncomfortable, there is a 50% chance right now that they may raise their Sing dollar trading ban come April. So what that means is that before the MES meeting, likelihood of Sing dollar rising is higher. Then after that, you have USD coming down, and then you'll probably take Sing dollar around. So ending the year roughly flat. Okay. And last product that we do have that we usually encourage every client to consider is gold. So we do have over-the-counter gold, and we do have options on gold. And usually people will tell you gold is a hedge against inflation. So is that true or not? So what I did here is that I just took the price of a Big Mac in 1996. And why a Big Mac? Because it's something that is very, very, can be found in any country in the world. Accessible to the person on the street, not only to the rich. It's a synthesis of marketing, logistics, retail space, employees working. So it's got everything coming into a very efficiently priced product. So you can see from 1996 to 2021, within the 25-year period, the rise in price of a Big Mac over in the US is 59%. But for gold, it's 78.4%. So is it true that it's a hedge against inflation? So for this purpose, the answer is yes. So that's why it always makes sense to have some gold in your portfolio. About 1.5% of your portfolio in gold is something that is a great diversifier. So you can consider gold. We see price now is about 1,818. We expect it fair value to be 1,843. And with that, I'm finally done. Thank you.
Without further ado, I'd now like to invite Clara Cheong, Global Market Strategist with JP Morgan Asset Management, to give her presentation.
Hi everyone, I'm Clara Cheong, Global Market Strategist at JP Morgan Asset Management. First of all, I would really just like to thank the HSBC team for having me tonight, and also thank you to all of you, our valued clients, for taking time on a Tuesday evening to join us for dinner. Hopefully you'll find this presentation insightful. So before I begin the presentation proper, and because this is my first time back in KL in 2023, I would like to wish all of you a very belated but Happy New Year, and hopefully this year will be much better than the last. As we all know, 2022 was a very difficult year for markets. And fortunately, it looks like 2023 is shaping up to be a much better one. While not all of the risks have gone away, the biggest risk of all is actually not taking one, which is why in today's presentation, I am very focused on sharing where we as a firm think makes the most sense for you to be taking these calculated risks. And to do that, I will be taking all of you on a trip across the world, evaluating the inflation as well as the growth outlook, thinking through how that feeds through to central bank policy, and then eventually how to take all of that and tie it all together into an asset allocation. So without further ado, let's get started. So after 2022 ended, we once again found ourselves at a macro crossroad. With US inflation having peaked back in October, what's going to happen to growth? Are we going to get a global recession? So these are questions that come up over and over again in my client conversations. So I thought, what better place to start than by addressing these questions head on? Because if some of the clients are asking these questions, it's most probably so that one of you in this room also has the same question. So I do think that whether or not we get a global recession, growth is going to be relatively slow, at least in the developed markets. So think US and Europe. But I think there are some key differences in growth trajectories across the world that are worth diving deeper into. So let's start with the biggest economy in the world, which is the United States. So obviously, we had a very aggressive Federal Reserve, hiking rates by a total of 450 basis points across the span of 1 year. This is the most aggressive the Fed has been in its history of hiking rates. And that's obviously a result of very high inflation. And because of that, the housing market has suffered pretty significantly on a year-to-date basis, and also in 2022. And besides the housing market, the higher rates have also impacted investment as well as business sentiment, which means that companies don't feel as confident anymore to keep investing, at least in 2023, to sustain the growth momentum. The bright spot is really in the left-hand side over here, chart over here, where I would direct your attention to the purple line. So that's the US consumer. As you can see, even though the purple line has come down pretty significantly, it's still positive, right? So US consumers are still, contributing to consumption growth at a rate of 2% per annum, right? Which is, pretty significant given that the US consumer is 2/3 of the US economy. Now, we have to ask ourselves, is this sustainable, right? So how are they getting this money to spend? First of all, we had very generous unemployment benefits, right, which has clearly expired. But the US consumer has also built out a ton of savings, right, which they have drawn down pretty significantly on a year-to-date basis. So the latest savings rates number was about 4.7%. In the 5 years prior to the pandemic, that number was actually 8%. So you can imagine how much of their savings they are drawing down to continue to sustain this growth momentum that we're seeing in consumption. The other thing that is supporting the consumer is the labor market, right? The labor market is very tight. Marcus had gone through that. James had also reiterated that. And, maybe the consumer is feeling relatively confident because they still have a job. But let's remember that a very resilient labor market is actually a double-edged sword. While it can support the consumer and help to support consumption, the issue is there is no way that the Fed is going to get comfortable with a 3.4% unemployment rate, which is the lowest in 3 decades, as well as a 4 to 5.5% wage growth. Because that's simply not sustainable in their mandate to bring down overall inflation. So this increases the risk, at least in my mind, of a policy-induced recession. So if the Fed keeps hiking and being more and more hawkish, or they stay hawkish for longer, then it is likely, more likely than not, that the US will enter into a recession in the latter half of this year. Now let's move on to the Eurozone, which is also a pretty key economy in the Western world. So I think for the Eurozone, the story is very simple. In summer last year when I was giving this presentation, we were pretty sure that Eurozone was going to enter into a very deep recession. And the reason for that is because of the Russia-Ukraine war and what it did to its natural gas supplies in the Eurozone. However, let's fast forward to December. So, the governments really got their act together. They managed to, get liquefied natural gas from the United States. They built up their gas inventories such that, they were 90 to 95% of their tanks were actually full going into the winter. So what we had expected last summer, where there's going to be massive power rationing, shutting down of factories, disrupting industrial production, that actually didn't happen. And with a stroke of luck, the European winter has also been relatively mild, which means that all of the reserves of gas that they have built up, they haven't actually really drawn down on that significantly yet. So we think because of that, the Eurozone has avoided a very deep recession, but nevertheless, the high energy prices that a lot of these consumers have to pay just on their electricity and heating bills alone is enough to dampen confidence. And that's what you see on this chart. On this chart, we have a couple of indicators that we track that indicate the health of the overall Eurozone economy. And every time you see a flag, it means that that particular thing that we're tracking is actually declined to levels that are consistent with previous recessions. And you can see that across financial conditions, you can see that across the consumer, across the manufacturing sector, and even the labor market is on a deteriorating trend as well. So I think we're pretty sure that the Eurozone is going to enter into a recession, but it's going to be a relatively mild one. Now, China. We can't not talk about China because it is the biggest economy in the Asia region. And last year was a very tough year for China because of its dynamic or non-dynamic COVID-0 policy, alongside a lot more impediments on the regulatory front for tech, as well as clamping down on the property sector. Now, I think all of you track markets, and you're going to continue to see all of the economic indicators look very bad over the next couple of months. And is that a reason to worry? I would say no, because what we have to remember is that hard economic data is lagging, right? So it doesn't really actually reflect the improvement sentiment and activity that we're seeing at the moment. So how we like to track high-frequency growth and activity is by looking at unconventional indicators like the one that you see on the left-hand side chart, which is China major city subway passenger flow. So over here we plot, 3 lines, just to make it simple, of Shenzhen, Beijing, and Shanghai subway passenger flow data. And we didn't randomly pick out these cities. It's because these 3 cities actually contribute a big chunk of Chinese GDP. And you can see over here that the blue and the gray line that represents Beijing and Shanghai, subway passenger flow levels have actually recovered to about 80% of pre-COVID levels. So this is a good indication that life is gradually returning back to normal. People are going out, going to work, going to dine at restaurants, right? There isn't that big of a fear of the virus anymore. And in places like Shenzhen, which actually went through a pretty severe lockdown last year, subway passenger flow has actually returned to almost 120% of the pre-COVID level, right? Presumably because maybe people still don't feel as comfortable traveling overseas, so they are kind of directing all of their efforts in improving mobility within, the city itself. So all in all, I think it's a growth in the right direction in terms of a resumption to more normal life. But I think what's the most important thing about this Chinese recovery story is the pairing of 2 policies. The first policy is the easing of COVID restrictions, and the second policy is the easing of the real estate restrictions. Because if you remember throughout the year, the Chinese government had done all they could to try to revive the property sector. They cut 5-year loan prime rates 2 times. That's tied to mortgages. They made it, more easy, mortgages more easily affordable to, young couples. However, that didn't really do much because mobility was limited. Now that mobility has more or less resumed back to normal, and there's an easing of real estate restrictions, people can actually go out and view those houses and continue to build confidence and invest in the property sector again. So we do think, from our perspective, that this China recovery does have some legs, and it will continue to run for the rest of this year. Okay, moving on to the rest of Asia, I think this recovery in China that we're seeing will definitely continue to benefit the rest of Asia, and ASEAN is one prime example of that. I believe the other 2 speakers have gone through some of the details as well, but I wanted to point your attention to 2 parts. One is from the trade perspective, which is on the left-hand side chart, in terms of exports. So you'll ask me, okay, why am I saying that the Chinese recovery is going to help exports when all of the lines of these ASEAN economies are declining on a six-month moving average basis? Yes, I think it will continue to be a little challenging from an export perspective, especially for small open economies like Singapore, especially if you believe that the developed market growth outlook is weakening. However, in the last decade, I think we have to realize that there's also been a regionalization of trade that's happened in the region. So actually, a lot of these ASEAN countries are now exporting to China instead of just focusing their efforts on US as well as Europe. So with China reopening and demand ramping up again, that could help mitigate some of the export weakness that we could see as a result of the slower demand from the developed world. And then the other perspective is tourism arrivals. So if you look on the right-hand side chart, many squiggly lines, but I think the key message is none of them are close to 100%. Right? Even the best recoveries that we've seen in tourism is only close to 60% of pre-COVID levels. And this is very important, especially for economies like Thailand. And why is that so? Because if you look at Thailand, 12% of their GDP is from the tourism sector. And 30% of their overall tourism expenditure comes from Chinese tourists. So you can only imagine how the reopening of China will actually benefit countries like Thailand from a tourism arrival perspective, which in turn should stimulate a recovery in the overall services sector as tourists start to come back and visit Thailand as well. Now, so to sum up the growth outlook, I would say a much weaker growth outlook in the developed markets like US and Eurozone, as well as the UK, but that's very much offset by a much more positive and optimistic view on the growth outlook for Asia, that is led by the Chinese recovery overall. So that's one driver out of the equation. Now let's look at inflation. So the other question that I always get from clients is, so inflation has peaked in October for the United States. So is this something that we will continue to face for the rest of this year? I think the short answer is yes. Inflation is going to be something that we are going to have to deal with in 2023 as well. But the type of inflation that you're seeing is quite different. Because when I was giving this same presentation last year, when inflation was starting to ramp up, a lot of that inflation was coming from food as well as energy prices as a result of supply chain disruptions and the Russia-Ukraine war. Right? So if you look on the right-hand side chart, if you trace all the way back to January, February 2022, you'll see that the blue part of the light blue part of the bar and the gray part of the bars were more significant in its overall contribution to inflation. But you fast forward to today, the type of inflation that we're seeing is I think, a little bit more concerning because it's more on the services side, like rental inflation, airline ticket prices, hotel prices, dining at restaurants, like all of those prices have started to increase. And the problem with this set of services is it tends to stay and be sticky for a little while. So I think that's something to bear in mind in terms of the inflationary dynamics that we might have to deal with this year. But I think there is no doubt, in my mind at least, that the headline inflation, which includes energy as well as food, is coming down. And it's for a very simple reason, because if you were to track oil prices or food prices, that's deflated anywhere between 15 to 30% from the peak in May last year. So that should flow through from a headline perspective in a disinflationary impact. But we still have to be careful of what we are seeing in core services. So this right-hand side chart over here kind of worries me a little bit every time I look at it. So this is what economists expect inflation to do over the course of this year. And I think it really stands out to me that they are pricing in a very steep and almost linear decline in inflation throughout the year of 2023. So you can see in the gray line that economists basically expect a straight line decline in headline inflation to under 3% for 2023. But I do think that the risk is in the actual path of inflation around this expected path that is priced in by economists. And that really matters because that's what's going to drive volatility in the rates markets as well as equity markets. So to give you an example, last Friday we had a core PCE number, which is a core inflation number, was announced. It came in at 4.7%. It re-accelerated a little bit from the prior month, but nevertheless, it's still on a declining trend. But markets sold off. And why is that? It's because the market actually expected 4.2%. So even though inflation was declining, it was not up to expectations. And that caused a sell-off in equity markets as well as the rates markets. So I think, on a go-forward basis, that has significant implications for asset allocation. So taking the inflation and growth outlook into account, what are central banks going to do? So from our perspective, because we do expect that core inflation can stay a little sticky, rates can have a little bit more upside, we think that the Federal Reserve will actually hike rates 2 more times. 25 basis points in March and 25 basis points in May. So the peak funds rate, if you can call it, is 5 to 5.25%. Now, if you look on the right-hand side chart and focus your attention on the gray line, that's what the market expects too. So you can see that the market expects that the Fed goes to a peak rate of about 5.3% or so. It stays in the 5 range for a little while before going back down to cuts in 2024. So to a large extent, you can say that, yes, the markets are pricing in what we think the Fed would do as well. So what is the upside to rates? I think if inflation were to come in stickier than expected over the next couple of months, even if it's declining, the terminal rate pricing that you're seeing here could go even higher. right? And that's going to drive interest rates a little bit higher, at least in the shorter term. Which is why, from an asset allocation perspective, we much prefer shorter maturity paper from the 0 to at least the 5-year part of the curve, at least for the next 6 months, until we have some clarity as to what the actual inflation trend actually looks like and what we think the Fed will do from a reactionary perspective. So coming to the asset allocation section, if there's nothing that you take away from today's presentation, I want you to remember this term. It's called FIFA. It's not that hard to remember, as there's an association with the World Cup. But to us, it actually means fixed income is fashionable again. So with this massive reset in yields that we saw over the last year, I think fixed income is indeed fashionable again, right? But as we all know, fashion is seasonal. So if you don't want to stand out in the wrong way, you have to pick the right pieces for the right season. And for this season, one of the core pieces that we are recommending is short duration. So what do I mean by that? I know this is a lot of numbers and bars on this slide, but what I want you to focus your attention on is on the extreme right-hand side of this page, which is the 2-year US Treasury and the 5-year US Treasury. So we think because there could be stickier than expected inflation, which could cause some temporary upside higher in rates, clients are more well-poised in their overall portfolio allocation to be allocating to the front end of the curve. And historically, if you think back to the last decade, you will always be penalized for holding shorter duration paper because the Fed was at a zero lower bound and rates were basically at 0 to 1%, right? So if you deduct inflation, your real return is negative. But that's not true today because the Fed had increased rates so significantly over the span of 2022 that the front end of the curve is extremely high right now, such that the overall yield curve is inverted. So let's take a 2-year US Treasury, for example, 4.5% or so. If we stress it by 100 basis points, because there's an inverse relationship between bond prices and yields. So let's say inflation is hotter than expected and rates increase by 100 basis points from here. The total return that you can get from holding a 2-year Treasury is still positive. It's still 2.9%. And at first when I looked at it, I was like, is this an error? It's not. It's because you're starting at 4.5%. So even if you have 100 basis points increase in rates, you are still coming out positive because of the carry that you're getting from owning this exposure. So this really illustrates the power of carry. And let's say we are all right and we get a pretty mild recession in the US and rates do come down. The total return expectation over here for the 2-year US Treasury is 6.6%. So there is no scenario, that you can envision with regards to the trajectory of the US economy that will lead you to a negative outcome by positioning yourself in short duration fixed income at this point in time, at least for the next 6 months or so. That's why we think this is highly compelling. And then the next piece in this fashion wardrobe in fixed income that we would like to focus on is high quality. Right? Because there could be an impending recession that's to come in the US as well as the Eurozone. You're probably not getting compensated enough to take a lot of risk by owning things like emerging market local currency debt, emerging market hard currency debt, or very risky high yield. Right? So what we would like to focus on is the purple part of this chart, which is high quality investment grade bonds in the US, as well as US mortgage-backed securities. So we do think that these two exposures have historically protected investors really well, even in the face of a recession, being able to deliver positive total returns, even in the face of a recession, and hence, clients will be well poised to be invested in such exposures to prepare for those risks for the rest of this year. So this is diving a little bit deeper into investment-grade bonds, and I actually think that this is really interesting because if you look on the right-hand side chart, a lot of lines here, but let's just look at the gray one, which is the investment-grade credit curve as of today. So if you invest in a 3-year investment-grade bond, you can get a 5.5% yield. That's just table stakes. It's, just to participate in this game, you're getting 5.5% yield. If you extend your maturity out all the way to 30 years, and you lend money for 30 years to an investment-grade corporate, you get a 10 basis points pickup, 5.6%. So it's not worth it, right? Why extend your duration or your maturity risk just to get 10 basis points more in yield? It makes absolutely no sense, at least at this point in time. So we highly recommend, investors to focus their attention on high quality, but at the shorter end of the curve, to continue to clip this coupon with pretty good certainty that there should be little to no defaults in this space. And I think the upside here, that a question I always get is, it's only 5.5%, right? My cash is yielding me like 4 to 4.5. Like, why should I even invest in this to take credit risk? Absolutely right. When you invest in a fixed deposit, your money gets locked, and there's no credit risk, right? But there's also no upside. Whereas if you're looking at this 5.5% yield, if we do get a US recession and rates fall, there's an inverse relationship between price and yield. So, this 5.5% number is going to go a lot higher on a total return basis. So this is why bonds look a lot more attractive than cash, at least from our perspective. And then the other thing that I would like to cover that's very high quality in the credit space is US securitized assets. I know this is a little bit confusing and kind of, gives people shudders if they think about 2008 and what happened to the housing market and subprime and all of these things. But I think what I would like to assure clients is, the fundamentals of the US housing market looks very different today than in 2007, 2008. If you look at the right-hand side chart where we plot mortgage originations by credit score, you can see that the very dark blue portion and the purple portion, which is credit scores, the highest quality borrower with the highest credit score of 760 plus and 720 to 759 actually makes up the majority of mortgage originations in the US. So what does this mean? This means that the people that banks are lending money to are highly likely to be able to make good their interest payments. And why is that important? Because that's exactly what you need as a mortgage-backed security, as an investor in mortgage-backed securities, because you need that cash flow to come. And if the borrower were to default, then that's obviously going to have an impact on your cash flows. And I don't think that is the scenario right now. And let's not forget that these exposures are also agency-backed, so they are government-backed. So the risk that you're taking here is not credit risk, and instead is more like prepayment risk. So again, that's a differentiated risk factor to take into account when you're constructing your overall income portfolio from a portfolio construction perspective. So obviously, the asset allocation conversation is not complete if we don't talk about equities. So the question that I always get is, Clara, are you a bull or bear for equities? My answer is, it depends on where. So in terms of JP Morgan's view, we do prefer, if clients want to take risk in equity space, that they take it in the form of Chinese equities, both offshore and onshore, as well as Asia ex-Japan equities. And there's a very simple reason for that. It's because if you look at the chart on the top half of this page, direct your attention to China A, China, and Asia Pacific ex-Japan. Despite the run-up that we've seen in Chinese equity markets and Asia ex-Japan overall, you can see that valuations are still trading at or below their 15-year historical averages. So you may feel like you missed out and you're feeling a little bit FOMO, but the reality is that things are still cheap. Right, so given the macro backdrop that I described earlier, on top of the fact that valuations are still relatively cheap, I think that it's still a good time if you want to be putting some money into equities, putting money to work, that it be in China A, China, or Asia ex-Japan. Now, what about S&P 500 and Europe? Despite selling off 20% last year and increasing, maybe 3.5% this year, I think it's a little surprising to me that US equities are still expensive. If you look on the top left-hand side, 17.7 times next 12 months PE, that's still pretty significantly over its 15-year average, despite the sell-off that we've seen, by the way. So if you believe that recession is coming, and I think the probability is rising, this number has to come down, right? Which probably means that there's going to be a little bit more downside for US equities. And then for Europe ex-UK, same thing. If you are going into a recession, your multiple probably shouldn't be trading at above average levels. And then the other component that's important to take note of when you're investing in equities is earnings. Because in equity returns, you have valuations, you have earnings, and then you have the currency return, and obviously dividends, but that has minimal volatility. So knowing the trajectory of valuations and earnings is actually very important. So if you look at earnings over here, market consensus expects US to grow their earnings by 2% in 2023. Now that might seem like a low number to you, but it's extremely high to me. Because in the best case scenario, where US achieves a soft landing, it means 0 to 1% GDP growth, right? Which is very much below trend. And in those scenarios, historically, you've never seen the US deliver earnings more than 0%. So 2% is too high. And if US goes into a recession, typically what has happened to earnings is it drawdowns 15 to 20%. So again, 2% is too high for whatever scenario that we think the US economy is headed towards. Europe is the same thing. 1% positive expectations. If you hit a recession, it's going to go down much more, 10 to 15% at least. Now let's look at Asia Pacific ex-Japan. With China reopening, potentially hitting a 5.5% real GDP growth target, with the rest of Asia poised to benefit from this recovery as well, analysts are expecting a 1% earnings growth for this region. That's too low, right? Because I think they haven't gotten to the point where they're revising their models to take into account the better growth trajectory and the more normalized profit margin outlook that these companies can actually operate in over the next 2 years or so. So that number has to be upgraded. So if you think about it holistically, cheaper than average valuations in Asia ex-Japan, led by China, very bearish expectations for earnings that probably has to be revised higher. And on top of that, a US dollar that has been extremely rich, presenting a tailwind for Asian currencies, like what Marcus had gone through earlier. There's 3 engines, right, out of the 4 that is moving in the right direction for Asia ex-Japan equities. So to conclude, I think for clients that are a little bit more risk-taking and you want to dabble into equities, US and Europe is not the place to be right now. If you want to put some money in somewhere, Asia ex-Japan, China, that's where you should be. However, my highest conviction idea for this year is fixed income. So I truly believe that bonds are back. You can get equity-like returns with much lower volatility in your portfolio. And for the first time in a very long time, we're not looking at bonds just as a source of diversification, which is what we had viewed them over the last decade or so, but really as a source of real return, as well as a potential source of capital appreciation as well. So with that, I end my prepared remarks and would invite Rohan back on stage. Thank you.
And with that, I'd like to then invite James Cheo, Chief Investment Officer of Southeast Asia with HSBC Global Private Banking and Wealth, as well as Marcus Chia, Treasury Specialist with HSBC Malaysia, back on stage to join us for a panel session. Ladies and gentlemen, please welcome them on stage. Now we want to focus on the questions that you have. So if you have any questions, we have one gentleman that's raised his hand at the back already. So if one of the mic runners can just pass him a mic in a few minutes. We are going to, I have a few questions as well, but obviously I'm going to hold them because I know we are into the Q&A time already. In the meantime, your Slido questions, if there are any, will pop up on screen here. If there are no questions, I will have my own questions as well. So we have one question over at the back.
Hi, good evening.
Good evening.
I want to ask you, what do you recommend to invest in equity or in bonds, looking into the current situation of interest rise, and which may not happen, as you say, in near future, it may come down, so, or it may stabilize. So what is your recommendation? This is my question number 1. The question number 2 is that how do you see ringgit against US dollar in next 2 quarters? Thank you so much.
Thanks.
Thank you very much for your question. So we've got questions for everyone here, actually.
Yeah.
So who wants to take the...
I'll take the first question, and I think at the heart of it, it's really about asset allocation. Asset allocation is key. So you first have to decide based on your own objectives, your life stage, how much you want to put into bonds, how much you want to put in equities. And I think you have to decide on that. So that's the first part, and it's different for everyone. So I think that's number one. And the second thing, I think, in terms of the views, I think we share fairly similar views in a sense that right now it's really fixed income. We are overweight on bonds. We prefer that to cash, really because of the very high yields that you can get at this point of time, 5-6% from the investment grade side of things. And also you can get the capital appreciation if rates do fall eventually. So bonds is really a place where we think the risk reward is suitable. That's why we are overweight bonds. Equity side, we are a bit neutral, and we want to kind of look for opportunities as it comes along the year. Clearly, the opportunity to us right now is actually in China, Asia. Maybe second half, if we do get a pullback in US or global equities, maybe that's the time to think about it. So you should actually think about bonds very seriously now. If you haven't deployed, I think that's the first place to look. And of course, in terms of equities, you can slowly sequence your investments into it.
I guess I would add that for me, sorry? Ringgit, yes. But let me just add on that point first. I think for me, fixed income, especially high quality fixed income, is a very compelling trade right now. And why do I say that? It's because you can have exposure to US investment grade bonds regardless of what your view on the trajectory of the US economy is. If you think there's going to be a recession, yes, spreads could widen, right, which could lead to losses. But if spreads do widen, we don't expect it to widen very significantly because the fundamentals of the space is extremely strong. You're looking at average interest coverage ratios 13 times, right? And you're looking at net leverage 2 handle, right? So these companies are more than able to make good on their interest payments. And on top of that, if a recession were to materialize, to James's point, treasury rates are going to fall, which means that you're going to benefit from a total return perspective. Now, if you don't believe that there's a recession, you believe there's a soft landing, in that scenario, why is there a soft landing? There's a soft landing possibly because inflation is moderating lower up to expectations, and the Fed can actually step back. So in that scenario, treasury rates will fall as well, and you can possibly also see some spread compression. So you benefit again from a total return perspective. So if you look at it from a scenario analysis perspective, this is basically something that is incredibly difficult, I think, to lose money on, which is why it's so compelling. But I'll let Marcus answer Ringgit.
Okay, I think we've been repeating it, that USD is likely to fall. I think the wealth of evidence we have before us tells us USD is peaking. It's been high, relatively high for the longest time, for years really. We had crisis after crisis after crisis. Every time USD was propped up. So at this point in time, with very transparent guidance from the Federal Reserve, it looks likely that we are reaching that peak already. And where we expect Ringgit to be at year end will be about 420. So that would be a good, very conservative number to use if you're going to plan out your investments. Okay.
Thank you very much. I'm going to take 2 questions from Slido, and then we'll return to the floor again. So if anyone has any questions, give us about a few minutes, and we'll return to you. At the very top here, we have, I think, a question again for Marcus. UK is a lagging economy. Why do you say that the pound is undervalued? Anything you want to add there, Marcus?
Okay, so what our main premise is that the UK is coming off a very low base. Like going through Brexit, a lot of people were overly bearish. And when Liz Truss was in government around October, people were even more bearish. You also had the Bank of England coming out saying that you have 5 quarters of negative GDP growth. So all in all, people weren't too keen to hold the pounds. So coming off that base, we reckon that the pounds is relatively cheap, relative to, say, even Ringgit. And within the space of, say, 1 week, it was proven to be true. It hit 540 today itself. So we reckon there's still some space for it to run about 600 pips or so, for it to be fair value by year end. So that's the crux of it, that there was just so much negativity priced in.
Marcus, there's another question on currencies very quickly. I think we've already touched a little bit about the ringgit just now, but we've moved from the pound across the pond to the dollar. If the dollar will resume weakening up to end of the first quarter, which currency should we switch into? I'll leave this to you, to however you want to position that.
First off, I want to clarify that in Malaysia, currency is a needs-based. Under Bank Negara's recommendations, a needs-based business. So I won't recommend to you what to buy, but we tell you where we think that may be capital gain. HSBC itself particularly likes undervalued currencies, for example, Japanese yen. Something very unusual. Most people won't think about it because you don't know what to do with it apart from going there to spend it. There is opportunity there because it's very, very undervalued. We also like the Australian dollars as a proxy to what's happening in China, the good news that's coming out from China. So right now, Aussie is about 302, 303. We reckon fair value by year end will be about 319. So Australian dollars makes sense. Interest rates there are actually rising as well. So you can get decent deposit bases in Australian dollars. Those would be probably the two main ones we continually bring up with clients every single day. Also, in a smaller way, we do like gold. Gold has been very volatile, but it continually hovers around a decent, very transparent price point. And that price point at present is about 1843. So gold is something else I think our relationship managers often talk about. So those would be the three things that I would recommend you to find out more, especially from your RM.
Do we have any questions from the floor, or should I be looking at the Slido again? The same gentleman has put up his hand. There's no one else? If no, oh, wait, we have another question. Sir, we'll get to your question also in a bit.
Hello. Yeah. Hi. This question is going to Clara. Clara, I enjoy your talk. Slide 17. Can somebody put back slide 17?
That's a test.
See, I wasn't focusing on my dessert. I was focusing on her talk. Yeah. Slide 17, please.
Which slide is that? Sorry, could someone help pull up the slide deck?
All right. Maybe while waiting for it to flash, this is the one on the earnings expectation.
Okay.
And I was kind of surprised that and it has that 4 color. 2021, 2022, 2023, and 2024.
Yeah.
And particularly on Asia Pacific. Can I assume that China is there?
Yes.
Okay, great.
China is 35% of Asia Pacific.
Absolutely.
Yeah.
Now, which is kind of disappointing. Now, 1% for this year means that you all do not expect China to bounce back.
Correct.
Can you explain why?
So, there's actually a better chart that kind of decomposes all of the earnings expectations by country and by sector in the Asia Pacific region, and I'll be sure to share that with you later. But just to give you a quick gist of what's driving that 1% number, actually China earnings expectations are positive. Right, so we are seeing about 15% for 2023 and 16% for 2024. However, China is only 35% of the index. There's another big chunk of it, around 30% or so, that is Korea and Taiwan. And because of Korea and Taiwan, analysts are expecting negative 18% for Taiwan and negative 33% for Korea. So you can just imagine, you multiply that, the contribution is basically negative. Now, what do I think about that? The magnitude of the negative number, if you track the global semiconductor inventory cycle, it's pretty much at its trough already. It should start to turn relatively soon. And typically when you do see that upturn, analysts upgrade their earnings on a lag. Right? So that's why I think there's so much more room for Asia Pacific ex-Japan earnings expectations to get revised higher, which should help overall total returns at the index level as well.
All right. We have a question here from Anonymous. With trade sanctions and wars, how can Asia economy be resilient against this, as the US market is still one of the highest and China is the strongest trading partner? Who wants to take this one on?
Well, I can take that. The thing about geopolitics and tension, it's going to be around. It's hard to kind of predict whether will the risk go up or it goes down. But if you look at the trend, even despite of all these geopolitical tension, global trade still continues to increase, especially even in Asia. But I would have to kind of caution that this, underneath the data, there will be some trends that are developing. I think for one, you're going to see supply chains relocating or locating at certain centers, perhaps one that's centric around China, and increasingly Southeast Asia as well. And of course, there will be supply chains that's going to be much more concentrated in the United States. And the tensions are going to be fought on various dimensions. Of course, it's going to be fought on the technology space. US, Microsoft introduced ChatGPT, that's AI. It's actually very powerful. Have you all tried that? Searching. It can do quite a lot of things, write a speech, write a poem, whatsoever. But more than that, it's going to become the door to the internet, because Google has been the door to the internet. So whoever that owns a smarter search, kind of AI that does that search, at least at the starting, would have the access to internet. And it's not just the United States that's pushing ahead in that. China is also pushing ahead with their own sort of AI. So that's going to be where it's being fought. And clearly over the last 10 or 5 years, it has been fought along semiconductors, who's making better and faster chips. US is still having the lead, but China is also catching up. So these are the dimensions that's being fought, and of course, you're going to get relocation of supply chains. And clearly, I think late last year, United States introduced the Inflation Reduction Act. It's nothing to do with inflation. It's really to subsidize green investments and green technology to have everything produced within the United States. Almost $400 billion earmarked for that. This is a good competition, but nevertheless, I think these are where the areas of kind of tensions would be. Technology, it will be on even in areas such as energy security. And I think that as investors, it's not something that one should be worried about, in the sense that we know that it's going to be present, but I think you want to kind of use volatility to kind of position into longer-term trends such as how you can benefit from the supply diversification. ASEAN is one example that could benefit from it. You want to look at certain trends such as energy security, so green transformation, particularly in Asia, it's going to be very crucial. China is building up solar and wind panels at very fast speed, because the thing about China is that they have no oil, and they don't want to depend on the Middle East or America for oil. So you can see some of these big teams developing as a result of the geopolitical tension. And I think that's how investors should think about it, and of course to be positioned for it for the longer term.
Thank you, James. Anyone else have anything you want to add to that?
Oh, and I think, the question specifically on geopolitical tensions aside is also how can the Asia economy stay resilient? So if you think about growth, I think it's always helpful to come back to frameworks, because if you think about real GDP growth or GDP growth in general, it's not just trade, right? There are many components to this: consumption, there's investment, there's government spending, then there's net exports. And if you think about what we've been saying earlier in our presentations, we completely acknowledge that the export picture is going to look a little challenged, right? Yes, China reopening can help mitigate some of that, but the reality is that the Western world, Europe and US, which are big trading partners of many Asian economies, is going to slow down. But I think what we're saying is this China reopening story is going to stimulate the domestic consumption and services sector. And that's where you're going to see a little bit more of an offset from the weakness that we could possibly see coming from the trade front. So overall, I think for 2023, you're still going to see an overall Asian economy that is still relatively resilient, despite geopolitical tensions, related trade wars, or a decline in exports due to a slowing demand from the West.
Thank you for that. We've got a question here on commodities at the very top. It's been upvoted twice. What is your forecast for the price of general commodities and energy in 2023 in light of the forecast of recession in US and Europe? Do any of you have any thoughts on this that you'd like to share?
Well, I think commodities or oil is a difficult one. To me, I think near term, you're going to expect elevated prices really because of, on the supply side of things, it's a little bit tight. And of course, production curbs by OPEC. But of course, on the demand side, you have slowing demand from Western economies, but you also get China's reopening. So that, I think, will provide some support, at least elevated prices in the near term. But I think slowly it should start to stabilize to roughly, I think it could actually stay roughly at where the current levels are. So I think this is, in terms of oil and commodities, I think largely, I think that's the picture. But also very importantly, I think one also have to be very nuanced in the entire commodity complex, because every commodity, there is particularly in the whole space, you have agriculture, soft commodities, hard commodities. But one thing you have to kind of break down is that, to me, the reopening of China is not so much, it's a consumer-led sort of consumption, one that is going to consume more services, is going to shift from goods consumption to services. So in that sense, it's not going to be very much of an industrial type of cycle that this reopening of China that's going to lead. Unlike past cycles in which when China stimulates economies largely through the industrial side of things, and then you see huge booms in metals and hard commodities. This time round, I think it's slightly more nuanced. It's largely through services. It's whether it's tourism, whether it's consumption of food, etc. So I think it's going to manifest itself a little bit differently, and that's why I think the impact on the commodity market will be a bit different from the past cycles where China went on the big infrastructure of fiscal spending.
All right. Clara, Marcus, anything to add to that? We're going to be taking one more question here from Slido, and then we're going to be wrapping up. It's already 9 p.m., ladies and gentlemen. And the top question here is related, I think you were talking about this a little bit earlier, James, geopolitical risk, but the tension. But this particular question is directed towards how do we hedge against that? Do you have any thoughts on that?
Yeah, well, I think there's no way to eliminate geopolitical risk out of your portfolio. There is no silver bullet. I wish there is. But I think it's really about asset allocation, because once you find how you want to divide up your assets, you want a pot that earns you, it's safe, secure, earns you a good income. That's where the bonds come in. You want a pot that helps you get growth, and that's where equity markets come in. And of course, you want a pot that it's a little bit more towards the alternatives, things like commodities, gold, for example, currencies, the dollar, etc. So the alternative pot sometimes could do well in a geopolitical tension. Commodity price usually goes up when you get some of these tensions, or even US dollar. So I think at the end of the day, it's to have a diversified portfolio, one that suits your need, build it very early on, and let the magic of invested portfolio compound over time. I think that's more important than trying to kind of predict what will happen in world affairs, or trying to hedge it through, or trying to trade a geopolitical tension, which is actually very difficult. And I think, and of course, the case in point is this. If gold price, for example, one would think gold is a good hedge against geopolitical risk. But look at what happened. Gold essentially, before the Russia-Ukraine war, gold price did not rise a lot. If I told you at the beginning of 2020, a year ago, that you're going to get a war, you're going to get the highest inflation in over 4 decades, you would think that gold price would triple or go 4 times, or you would put everything into gold. Guess what happened? Gold price essentially was flat. And that goes to show that it's not so much on trying to hedge and trying to predict, but rather prepare. And prepare is really through having an asset allocation strategy that suits you, that's built over time. From time to time, you make a little bit of tweaks, but by and large, that strategy should stay with you over time and help you grow, rather than trying to put all into one asset, put one all out, or try to time things, because geopolitical risk is really, really so hard to kind of predict.
Thank you, James. Before we wrap up, Marcus, Clara, do you have anything you'd like to add before we close off? All right. Ladies and gentlemen, a round of applause, please, for our distinguished panelists here. Ladies and gentlemen, that was James Cheo, Chief Investment Officer of Southeast Asia with HSBC Global Private Banking and Wealth, Clara Cheong, Global Market Strategist with JP Morgan Asset Management, and Marcus Chia, Treasury Specialist with HSBC Malaysia, sharing with us their insights into global markets.